Hello, everyone. Welcome to our channel, Fifth Dimension. My name is Hasha Shafi, and with me, we have Wasif Heather, who's going to use his finance knowledge in analyzing a very hot stock today, NVIDIA Corporation. Yeah, we are going to see if it's worth buying, and if it is worth buying, then at which price should we buy it? So without further ado, I would like to invite Wasif to dive into the analysis.
Thanks, Hashim Shafi. As Hashim mentioned, that today we will be evaluating a very hot stock, NVIDIA, and we will be using the principles from the book of Benjamin Graham, The Intelligent Investor, and also from the principles from the book of Phil Town, Rule Number 1, and we will come up with a price, and we'll see and evaluate that price with the current price, and then we'll see if it's worth buying or not. So first of all, in the book, rule number 1, Philtown says that first you should you should see if that company has a moat or not. That means if it has a competitive advantage or not compared to other companies. This is what many known investors also say, that we should look if the company has competitive advantage or not. So for that, first we will see a very important number called ROIC, return on invested capital. So the definitions of these terms we will tell in some other video, but right now we won't be going through the definition, we will just see the numerical value. So first we'll see what is the ROIC of NVIDIA for last 10 years. And it has to be more than 10%. So for that, we will go to finance charts. I will be posting all the links of these websites in our description of this video. So if you see NVIDIA for last 10 years, then it is around 52.58%. So it's well above 10%. Now you'll see sales growth rate. So the sales growth rate for last 7 to 10 years should be more than 10%. So for that, we will go to msn.com and we will search for NVIDIA, and then we will go to analysis, and there we will go here at income statement, and then we will see that it grows from 6.91 to 60.92. So in 7 years, from 2017 to 2024, it grows from 6.91 to 60.92. And we'll see for what is the growth rate, average growth rate. And for that, we will go to the website rule number 1, rule1investing.com. I will be posting the link of that as well. I post every link, so don't worry. And then we go to investment calculators. Just a moment. Let me refresh. So now we have investment calculator, and then you'll see the sales growth rate or the revenue growth rate. So initial sales were, if we remember, was 6.91, and then it goes to 60.92 billions in 7 years. So you can see it's 36%, which is well above 10%. So our second important number is also checked. By the way, Hasha, you could also ask questions in between. It also helps our viewers as well. So if you think it could be difficult for the viewers to understand, so you can interrupt.
Sure. I think so far it's self-explanatory.
Thanks a lot. Now we will go to the third important number, is called earning per share growth rate. So it is in the same link in investment income statement. And there we will go a bit down, scroll down, and then you could see EPS, earning per share. And it is going from 0.06 to 1.19 in 7 years. So we will go to.
I think it
Mhm,
would be helpful to spend a bit upon earning per share. What is earning per share? What is the difference between
mhm.
earning per share and diluted earning per share? I think it would be useful for people to know.
Okay, okay. Actually, they are the same numbers, as far as I know, diluted EPS and like normal EPS. But I can just tell briefly because we will be posting detailed videos on that, explaining what is EPS and what is diluted EPS for the viewers right now. They can consider it's the same, and I can just shed light, a bit light, on what is earning per share. So it is like if you have the profit, the whole company has a profit of 100 euros and there are 10 shares in the market. So you will divide that profit with the number of shares, then it will be earning per share. So it's 10. So 100 divided by 10 is 10. So the earning per share, how each share is earning for you is earning per share.
Okay.
It's from the name you can also see what it's mean. Just I
So
explained. Mhm.
what each share has earned in a year. So that
Exactly.
is earning.
In a
Yeah.
quarter or in year, on average, here is an year. Yes. So now we will calculate the EPS growth, the earning per share growth rate, and it also has to be more than 10% on average in last 7 to 8 years. So the initial EPS was 0.06 and it went up to 1.19 in 7 years. So it's 53%. So it's well above 10%, as you could see. You have any
So
question? Mhm.
yeah, I would like to just repeat that so that it sticks with the audience. We are going to see 5 different values if they are above 10% for the last. So ideally 10 years, but since we have open access data for 7 years, so we are checking for 7 years, and it should be above 10%. So far, we have checked return on investment capital, ROIC, second sales growth rate, and third EPS. So all three are above 10%. Now we are going to see the rest two of them.
Sure, sure. And the next one is it's a very important number. It's the equity growth rate. Equity, we will explain what it is in a separate video, but right now we'll just see the numbers. So for equity growth rate, we will go to balance sheet. It's just beside income statement. And it went from 5.76 billion to 42.98 billion. And we'll go to rule number one, we'll go to investment calculators, and then we will go again to equity growth rate. And it was 5.76 and it went up to 42.98 billions in 7 years. So it's 33%. So it's also well above 10%. Now we will go to the final number to check mode. And if, as Hashim mentioned, if all of these numbers are above 10%, then this company has a competitive advantage over others.
I
And
would like to
mhm,
just add a sentence about equity. So it can be simply understood as ownership. So shareholders' equity means that shareholders owned a lower number. It was, yeah, as showed her in his analysis, like it went from a lower number to a bigger number, and we were checking if it is growing at a rate of 10%, and it was way above 10%. So the fourth value is also uh, above 10% and fulfills our criteria.
Sure, exactly. Now you'll see the final number for checking the mode. It's called free cash flow, and it is going from 1.5 to 27.02. And for that, we'll go to the same website, investment calculators, and then we'll go to operating cash flow. And we'll see the old one was 1.5 and billions, and it went up to 27.02 in 7 years. So it's 51%, which is also well above 10%. So we have checked that all of our 5 big numbers, as Philtown mentioned them as big numbers or call them as 5 big numbers: ROIC, return on investment capital, sales growth rate, earning per share growth rate, equity growth, and free cash flow. They all are for the last 10 years above 10% for last 7 years. And now we will calculate the margin of safety price. What is the intrinsic value of NVIDIA right now, expected value? And we'll see, compare it with the current price. And if the actual value with the margin of safety is less than current price, then it is recommended in that book to buy. But just a disclaimer, we are not your financial advisor. It's just a suggestion. It's just knowledge sharing. We are not suggesting anything to like go right away, buy it, do your own research. But this gives you a foundation of how to look for a company. Now we will calculate the margin of safety price, sticker price. So it requires us to have earning per share, current earning per share. So don't confuse it with the growth of earning per share, but what is the earning per share for last year, for last 12 months. And for that, we will go to, again, amazon.com, and we will go to summary. And we could see for TTM for last 12 months, trailing 12 month it's 1.71. So you could just write here 1.71. And now future growth rate. For future growth rate, in the book, Philtown suggested that you have to look for 2 numbers, either equity growth or what the analysts are saying. So we remember that, and whatever number is smaller, we will choose it as our future growth. So equity growth rate was 33%. Now we will see what analysts are saying on Zacks.com. And there we will search NVIDIA, and then this is the table. And you could see that expected EPS growth is for the next 3 to 5 years is 37. So obviously 37 is more than 33%, so we will choose 33%. And now the future PE. For future PE, Philtown suggested to look for on average what is the PE for last 10 years. Then also see what is the twice of equity and choose the lesser number. We have also added an additional criteria which make it even more conservative to look for what analysts are saying. So equity was 33%, so the twice is 66%. We have already calculated the last 10 years average PE, which is 59, and we will see now what on Zack are saying, investors are saying. So it's 48%. So this is the lowest number among all 3. So we'll choose this as our potential future PE.
I think it would be helpful if we show how we calculated the average.
Yeah, sure. I can just go through. We don't have to go through the whole calculation, but I can tell them where to find. It's a nice point. So we will go to summary again, and then we'll go to analysis, and then we'll choose annual, and then we go down, and under the heading of valuation, This is price to earning. And what we'll do, we will calculate the PE for each year for like 8 years and add them and just divide it by 8. So this will give us the average PE for last 8 years. So as Hashir mentioned, that it's an open access, so they have the data for 7 to 8 years. But if you go for paid version, and then you can have even more years. But if you guys know any platform which provides the data for more than 10 years and it's open source, please let us know in the comments. Now it was 48.2%. 48.2%, sorry, 48.2, not percent, just it's a PE, it's a ratio, so it's unitless. So we could see that the sticker price is 353, but they say all the big investors that you have to also have a margin of safety. So you divide it by 2. So it is 176. Not only Phil Town, but Warren Buffett also says that you should have a margin of safety. Benjamin Graham says you should have a margin of safety. And he also stressed, Warren Buffett, that the company should have a competitive advantage as well. And rule number 1 tells you how to find it. So right now we could see the price with margin of safety is 176, sorry, the value. And if we compare it with the price of NVIDIA, it's 129. So it is undervalued. So if we look only the book of Phil Town, then it is recommended to buy it right now because it's well undervalued. But we are not just following blindly one book. We have to look other books and what other known investors are saying. And according to that, if we look into the book of Benjamin Graham, the intelligent investor, they suggested in the book that you should never buy a stock or avoid a stock who has the current PE more than 60. And if you could see that the current PE of NVIDIA is 75. So I personally, now I would stress that point again, that it's a disclaimer, we are not your financial advisor, but personally myself would avoid this stock because the PE ratio is too high. So although if you see just one book, it's recommended to buy, but if we look a bigger picture, then it could be scary because it's well above 60, the PE ratio. And if it goes low, we will see it again, evaluate that share again. But for right now, I would suggest, it's just a suggestion, that I will avoid that stock. And now whenever we calculate these stocks every week, different stocks, and then we add the entries of these stock, the values, and so on, in this spreadsheet. And you could see we have a lot of companies. We mention if it has a moat or not, what is the margin of safety price, and what date we calculate, and so on and so forth. So if you guys want to have this sheet, please let us know in the comment. We will send you, if you subscribe to us, we will send this to your email. And that is all from my side. Now it's over to you, Hashir, to conclude this this session of ours. Thanks a lot.
Thank you, Wasif, for a thorough analysis. I would just conclude the session by telling you the philosophy behind this method. So first of all, we find out, so it's just the quantitative analysis. In rule number 1, Phil Town also mentions that you have to know the meaning of the company. You should understand the business, how the business generates money. The management, you should know the management, how much they care about the shareholders and how competent are they. So we are not covering that. That comes under qualitative analysis. We are just doing quantitative analysis. And if we go to the price, if you look at the price sticker price that we calculated, and then there's margin of safety. So sticker price is basically the deserving price that we should pay for this stock to get a 10% rate of return, a 15% rate of return in the next 10 years, an average 15% rate of return. We could get that, but when we calculate the margin of safety, uh, we apply 50% margin of safety in case things go wrong. And if the value is below that 50% margin of safety, then we are kind of in a safe range. So it's like buying the stock on sale. And I think now this stock is on sale, but as Wasim mentioned, the price to earning ratio is too high, and the author of Intelligent Investor, Benjamin Graham, he recommends against it. So yeah, our suggestion is to not go with this stock, but it's still like it's up to you um, if you want to buy or not. The price is well below the sale price. Thank you, and see you in the next video.
Thanks a lot, everyone. See you guys in the next video with some other shares to evaluate.